Hello, I'm a retail investor and I have always had a passion for numbers, economics, and investing. However, the longer I've been around this environment, the more corrupt I realize it is, and I believe I have to try and do something. And hopefully, politicians, voters, and lawmakers will listen. We've all heard people complain about the greed of Wall Street, the huge profits, and CEO salaries. But I'm not going to talk about that because there is something I find much more frustrating. The little money we average individuals do have to invest is literally being stolen away from us. I will start off with a simple example of how market manipulation is stealing from all of our pockets, and then get into some more complex specific examples. To begin with, high-frequency trading firms, or market makers, account for more than half of all equity trades and argue that they provide liquidity and benefit retail investors. Let's take a look at one such firm, Virtu Financial, a company that went public recently, which boasts of having only one day of losing trades in 7 years, with $723 million in revenue and $190 million in net income in 2014, with those numbers no doubt having risen last year. This business is so lucrative for them that they actually pay millions to trading brokerages so they can get all of our order data, and they also pay millions more to have the highest speed, closest proximity order routing so they can get in front of all of our orders. So what do? They use sophisticated trading instruments to make trades in fractions of milliseconds, matching orders, selling us the shares when we try to buy, and buying our shares when we do want to sell. How noble of them. But wait, there's a catch. In actuality, they are really just acting as a middleman and making massive profits doing it. Let's take a look at a simple example. Let's say a stock is trading with a big spread. For this example, we'll use a bid of $10.50 and an ask of $10.70. So $10.50 is the price buyers are offering to buy the stock for, and $10.70 is the price sellers are offering to sell the stock for. No trade will happen unless both sides can meet somewhere in the middle. But for lots of stocks, there are spreads anywhere from a couple of cents to even $1 or more for some higher priced, lower volume stocks. So Joe comes in and he really wants a stock, so he puts an order to buy at the market price. Meanwhile, Jane really wants to sell her stock, so she puts an order to sell at the market price. Well, our heroic high-frequency trading firm sees both of these orders before they get to the exchange. So their high-speed, high-frequency trading algorithm sells Joe some stock at $10.69, and the same instant buys Jane's stock at $10.51. Joe thinks himself lucky. He saved a penny on his order when he was willing to pay $10.70. Jane also counts herself lucky because she received an extra penny on her order when she was willing to sell at $10.50. Sometimes these orders will even be 1/10 or 1/100th of a penny. Ever wonder why you see weird decimals in your trading prices? That's why. Little do they know, had they both just bartered the old-fashioned way and met in the middle at $10.60, they both would have been 9 cents better off. Both retail investors are satisfied, blind to what is actually happening behind the scenes, and the high-frequency trading firm acts like it did a good deed. But in actuality, all they did was take both sides of a trade and made 18 cents profit in a fraction of a second by jumping in front of these orders to take advantage of each individual. They aren't holding any stock after this trade. They didn't provide any liquidity. All they did was take advantage of two retail investors who could have both been 9 cents better off without the high-frequency trader. The only reason these firms buy is because they know they can immediately sell at a higher price. And the only reason that they sell is because they know that they can buy at a lower price. They don't hold stocks or invest in companies. They provide no service or betterment to our economy. That $723 million in revenue Virtu made in 2014 is money taken directly out of the pockets of you and I, out of the average Joe and Jane, out of pension funds and retirement accounts. Upset yet? Well, that's just the beginning of how they take advantage of us. Even many retail investors won't pay the 1070 ask or sell at the 1050 bid from our previous example. They'll put limit orders or try to barter, and the effect won't be as great on them. But that doesn't mean they're not being taken advantage of by market manipulators and high-frequency traders. These high-frequency traders who buy our orders from our brokerage can tell what prices we are willing to sell at, triggering our sell orders and then letting the market price go back to normal levels. Remember the flash crash? Here is a recent example using KBIO stock. This is an actual example that happened to me with real data and real values. You probably know the stock. Martin Shkreli invested in the company. The stock went from $2 to as high as $45. Then now he is facing numerous charges from another incident, and the company is in bankruptcy protection. I bought the stock hearing lots of hype about it, but knowing it was risky and a pharmaceutical stock, I put a sell on stop limit to trigger at $1.97 and sell down to $1.95. But the stock was trading above $2 with lots of bids and buying interest, so it seemed like it was going to go up if anything. All of a sudden my order sold, partially at $2.01, then partially at $1.97. When I could see the bids, asks, and trades in real time on my trading platform, and they were all above $2. What happened? I wondered angrily. I immediately called my brokerage, TD Waterhouse Canada, who in Canada is not supposed to be able to sell order data to high-frequency traders. Yet they admitted it was market manipulation, but that there was nothing I could do. So what happened? Well, a market maker decided to sell at $1.97, probably only a few shares on an alternate exchange, triggering my stop limit sell order. Thus my stock was taken away from me. And then the market makers let the price go back up, higher and higher, up 25% in the next hour, then up to $18 that evening after hours, with a high around $45 a few weeks later. They were able to buy my stock at $1.97, knowing there were bids, so they could sell at $2.02 that same instant. That's 2.5% profit in literally a fraction of a millisecond. Do this for many thousands of shares all day long, and it's not hard to see how companies like Virtue Financial can easily make over $1 million profit every day without any risk of losses. Then there are other times where the market makers skip over your sell order altogether. For example, last week I wanted to sell a stock if it went below $31.90, but I wasn't willing to accept less than $31.70 for the stock, so I entered what's called a stop limit. The market makers saw I was willing to sell between $31.70 and $31.90, so what happened? All of the bids disappeared, and the stock all of a sudden went from trading around $32 to below $31.70. So my sell order was left open, and I had to either cancel or accept around $31.40 for my stock. This was not on a small stock in the middle of the day either. This was at 9:40 a.m., around the busiest time of the day, on a stock doing 1 million share volume that day, which had news. Market makers will do this on the buy and sell sides. If you don't put a limit order though, or do a market order, those market makers can cancel all of their orders before yours gets filled. And instead of selling at $31.90, where your stop was, who knows what price you will get. You'll likely have to meet the next retail order that isn't able to cancel in a fraction of a second, which could be a long way away. Or on the other side, instead of buying at $32, you might end up paying $33 or more. I've had many orders where I paid or received up to multiple percent worse than the previous trade. Market makers argue that they provide liquidity, but the liquidity seems to disappear whenever a retail investor wants to trade. As a result of this market manipulation, it is actually harming liquidity from retail investors. I myself am discouraged from placing buy orders because of the hundreds of times I have seen the market makers raise the asks as soon as I do. And I am discouraged from placing sell orders because I know all too well how quickly the bids will disappear before my order ever gets filled. So the investors slowly back away from markets, leaving mostly machines. Even when a retail investor gets an order filled, you may notice that you often don't get a full fill. Sometimes you might put an order for as many as 1,000 shares at a given price, and the market makers fill you for 100, then raise the ask. This happens a lot with options as well, where you may put in a bid for many contracts and only get a fill of one. So if you want the rest of your order, you'll have to pay more, which many people end up doing since they pay per trade commissions and clearly want the stock or option. A fantastic analogy I hear was, imagine you're going to buy tickets to an event for your family. You place an order to buy 5 tickets at $20 each. But instead of getting 5 tickets for $20, you get 1 ticket for $20 and notice that the price is now $25 per ticket. You can't do much with 1 ticket, so you're probably going to pay the $25 each for the other 4 tickets, even though you know you've just been taken advantage of. This strategy is common practice in the trading world. Market makers will indicate large asks or large bids, but then these will disappear before your order is filled. So it may look like they're willing to buy or sell large blocks of shares, but then all of a sudden these orders will disappear. So again, the liquidity is false or falsely represented. How bad is it? In Canada, the main trading brokerages are the big banks, who also have their own trading desks, something the Volcker Rule tried to eliminate in the US. Well, one of the traders for Royal Bank, Brad Katsuyama, the focus of the book Flash Boys, was so frustrated by the manipulation that he decided to pursue creating a new exchange. This is pretty horrible if a bank trader who trades for a living, with access to massive amounts of capital unfathomable to retail traders, order data for clients, and the experience and resources of someone who does this for a living, finds that he is being taken advantage of and cannot compete fairly with these high-frequency traders. So what chance does the average retail investor working in an unrelated field have? It literally sickens me to think of how corrupt the system is, and when I tell others, they are dumbfounded that all of this activity is not illegal. So please share, spread the word, pass it on to your elected officials or candidates. Let's fight back and stop letting others steal from right under our noses. Those billions of dollars manipulated away from us by high-frequency traders would be much better for the economy and the country in the pockets of you and I.